In contrast, half of the open positions in 2023 are low-income jobs, which often come with lower wages and limited benefits, making it even more challenging for individuals and families to make ends meet. The shift towards a higher proportion of low-income jobs and the decline in middle-income opportunities underscore the growing income inequality in the United States. As the cost of living crisis continues to worsen, the cost of basic necessities like food, housing, and utilities is soaring, putting a significant strain on household budgets. Moreover, with gas prices reaching an 8-month high and the persistent inflation, the financial burden on American families is mounting. Consumer confidence in the U.S. economy has plummeted, with a record 69% of Americans holding negative views about the economy's current state and its future prospects. The concerns are compounded by worries about job security, as a substantial percentage of the population fears potential layoffs and job losses. While some high-profile companies have already announced significant layoffs, the job market as a whole has been showing signs of strain, with employers adding the fewest jobs in 2.5 years. The diminishing number of job openings for middle-income positions further exacerbates the challenges faced by those seeking stable and well-paying employment. The economic hardships experienced by many Americans have pushed over 30 million people below the poverty line, highlighting the severity of the situation. It is evident that a large segment of the population is struggling to cover their basic needs and are forced into debt to make ends meet. In light of these statistics and the undeniable hardships faced by American workers, it is clear that the U.S. economy is facing significant challenges in 2023. Addressing the cost of living crisis, income inequality, and job security concerns should be top priorities for policymakers and leaders to ensure the well-being and financial stability of the American people. In 2023, American families are facing unprecedented levels of debt, which is contributing to a challenging financial situation for many households. According to Federal Reserve data, household debt has reached a record of $17.5 trillion. This debt includes $12.4 trillion on mortgages, $1.55 trillion on vehicle loans, $1.6 trillion on student loans, and $986 billion on credit cards. Surprisingly, 77% of American households now have some form of debt, the highest percentage in U.S. history. Additionally, the number of people falling behind on their debt is increasing, with delinquency rates rising for nearly all types of debt. Gen Z, Millennials, and Gen Xers carry the highest average debt amounts, and their delinquency rates are correspondingly high. Medical debt is a significant cause of personal bankruptcy, with over $88 billion appearing on consumer credit reports. The burden of medical bills and collections negatively impacts individuals' access to credit and can increase the likelihood of bankruptcy. A significant percentage of people with medical debt report low financial well-being related to this debt. A concerning trend is the reliance on credit cards to cover essential living expenses. Nearly half of Americans, and even higher percentages among younger generations, rely on credit cards to pay for basic necessities due to stagnant incomes and soaring living costs. Emergency savings are lacking for many Americans, with 25% having no emergency savings at all and 37% having less than $1,000 saved. The majority of respondents in a survey stated they would need to go into debt to cover a $2,000 emergency. Bankruptcy filings have seen an increase across all chapters, with a 27% rise in petitions during the first quarter of 2023 compared to the previous year. Large companies in the finance, insurance, and real estate sectors have also experienced a surge in bankruptcy filings. Furthermore, food inflation continues to rise, with grocery prices increasing by 20% since April 2021. The shortage of cooking staples, such as sunflower oil, has led to a 54% increase in margarine prices, while milk and bread prices have risen by 19% and 21%, respectively. The avian flu has caused a record drop in chicken supply, leading to significant price increases. These alarming statistics highlight the challenging economic situation faced by American families in 2023. Rising debt, increasing inflation, and financial insecurity are significant concerns that require attention and action from policymakers to alleviate the burdens on struggling households. In the past 2 years, the cost of meat, including beef, poultry, pork, and fish, has increased by 23%, putting a strain on American households. Many families are now forced to choose cheaper alternatives and cut back on their favorite foods to manage their budgets. Gasoline prices have also surged, reaching their highest level since mid-November 2022. The average price for regular gasoline is now $3.75 per gallon, which is about 23% higher compared to 2 years ago. The ongoing fluctuations in gas prices have been influenced by various factors, including geopolitical events and production caps. Rising utility bills are another financial burden on American households. Electricity and natural gas prices have soared, reaching record highs in some cases. This has led many homeowners to downsize their homes and cut back on various expenses, including entertainment, groceries, personal care, childcare, and healthcare. A Bankrate survey reveals that most Americans feel they are far from reaching financial freedom. Respondents reported needing to earn approximately $233,000 per year on average to feel secure or comfortable with their finances, and about 2 times more, around $483,000, to achieve financial freedom. These figures far exceed the average earnings of full-time workers in 2020. The burden of student loan debt is also taking a toll on borrowers. The total amount of student loans in the U.S. has exceeded $1.5 trillion, and experts warn that about 40% of borrowers are expected to default on their student loans this year. High levels of student loan debt and the uncertainty of job prospects are contributing to this concerning trend. Overall, these statistics paint a challenging financial landscape for many Americans, with increasing costs for essential goods and services leading to financial insecurity and hardships for a significant portion of the population. Many borrowers find themselves in financial distress, unable to manage student loan repayments. Defaulting on student loans not only negatively impacts credit scores, with defaulters averaging a score of 550, considered on the cusp of subprime credit, but it also results in higher interest rates, difficulties in renting or buying homes, and potential disqualification from certain jobs. Defaulting may even increase the borrower's balance due to collection fees and accumulated interest. Additionally, wage garnishments, tax offsets, and suspension or revocation of licenses further compound the negative effects of default. A staggering share of adults haven't saved anything for retirement. According to a study, 51% of U.S. adults aged 25 to 60 have no retirement savings, and 23% have less than $5,000. As baby boomers reach retirement age, 41% remain unprepared, with average savings of just $54,000. CBS poll survey reveals that a staggering 80% of American workers are living paycheck to paycheck, reflecting the immense difficulty in coping with the surging cost of living. Moreover, the data highlights another troubling aspect of the economic landscape. Nearly 15% of U.S. households are classified as asset poor, lacking sufficient financial reserves to weather crises effectively.